India has had a lot of scams and still having a lot of scams around it. So having a guideline brought the trust factor which was required into the industry.
P2P lending companies used to take their cut, right? And they used to say, okay, you will get up to 12% return, where it is written that return might go low if the receivable or the amount collected is lower than that. But it was always in fine print. So what happened effectively is that risk became investors, reward becomes everyone's.
Even China failed because the Chinese P2P companies became a credit aggregator and the regulator did not like it.
Hello and welcome to an exciting new episode of Fintech Ki Baat today. This is a special one because this is not your run-of-the-mill founder story or Dhande Ki Baat wherein we interview excellent entrepreneurs and take their insights. This is a special one where we talk about the latest guidelines of P2P lending that has been recently released by RBI to kind of shed a whole new light on what's happening in the P2P industry and curb some practices as well as give a better sense of direction to the players in the industry. And to discuss that, we have a couple of industry experts with us. Mr. Mukesh Bubna, who's the founder of one of the oldest P2P platforms in India, Monexo. Hi Mukesh, thank you so much for joining us today, and thank you so much for your time. And Mr. Vikram Pandya, who's one of the fintech experts in the country as of now, and he's also director of fintech with SPJ as well as heads investments and research at Varanium Fund. Hey Vikram, thank you so much for your time today. Great. So let's dive straight into it, right? I'm sure most of our audiences are aware about what P2P lending is and what's been happening in the industry. But for the sake of everyone, let's just take a quick step back and kind of dive into what essentially is P2P lending. What was the industry landscape like before the guidelines came in, and why essentially was the need for a model like P2P lending to exist in a country like India in the first place? So, Mr. Mukesh would love your insight on this first, and then Vikram would come on to you.
Peer-to-peer lending, as its name suggests, is one person lending to somebody else on an online platform.
Right.
We do that often between friends and colleagues or in the sari market or a diamond market, but this is online.
Mm-hmm.
This has been prevalent from 2004 from UK all the way to US, China, became a global industry where it landed in India around 2016.
Right.
The first P2P guideline, and before that draft discussion paper was available from 2016, came out in December 2017. So August 2006, this August 16, 2024 is reiterating the guidelines and maybe amended one or two provisions there. But the guideline existed from 2017. It required everybody to be regulated to operate a platform like this. And there were 25 licensed companies in which give or take 7 or 8 were operating. The rest were not operating. They had taken the license and not operating. And the need was, India is a growing country. Just like NBFCs are a wonderful extension of a banking system, provide credit. And we've seen how credit is important in every aspect of life. Similarly, the NBFC P2P guideline was again one more step towards making credit more inclusive. We had seen the impact of opening bank accounts, and if you don't have credit, again, the cycle to break the poverty is very difficult. So it's one of those things.
Understood. And from my understanding, there were still a few organizations who were in existence even before the December 2017 guideline came into play. So what I think Monexo was one of those, right?
Yes.
So what was the landscape like at that point of time?
There were 3 or 4 companies only before the guidelines who were operating. The business was really tough because consumers wouldn't trust the product. India has had a lot of scams and still having a lot of scams around it. So having a guideline brought the trust factor which was required. into the industry, and ability to then market it out to the consumers became easier, specifically from a perspective of taking money from the lender.
Right.
It brought in the required thing which was missing prior to the guideline coming. One is the escrow account. 2016 guidelines, 17 guidelines already said about bringing in the escrow account. And I'm very proud to again reiterate, we started the business in India in 2016, September actually. And we were the first one to bring the escrow account even before the guideline. And the
Good.
second, which it allowed, was allowed the P2P lending companies, which were prior to the guideline, were not able to report bad loans into the bureau or pull the bureau reports, were given the opportunity to be part of the larger ecosystem of the credit bureaus, etc. So those two helped.
Understood. Makes sense. Thank you so much for that. Vikram, one question for you. I remember back in 2018, when I was probably part of another fintech batches in SBJ, and you were talking about P2P guidelines. That is when the guidelines were freshly minted. So I think you having been observed this ecosystem from a third party perspective, since quite some time now. How have you seen that this specific segment evolve pre and post initially when the guideline came?
So what happened is that when you look at the reason why this P2P was required in the first place is that we had lack of platform architecture, or let's say marketplace architecture for the loan. Right? The idea was that when you look at bank operates by default, by nature inherently, asset liability mismatch. So that is one area. Second thing is that what bank tries to do is that, of course, they are intermediary any which way. So they try to make sure that they manage the risk, liquidity risk, interest rate risk, everything. And then based on that, whatever is the earning that they get. That is how the inherently the framework works. Which means that the depositor is getting fixed return, whatever it might be. While banks may revolve that amount with a credit card that they issue, or whether it is the loan that they issue, personal loan, home loan, whatever it might be. So based on the CASA that they receive, based on deposit that they receive, they loan out, and then they earn the spread based on that. Now the idea is that why can't we have a legal structure in India? And this is not only in India. Before even India started, globally also this concept was working, where people started thinking. So you have one extreme where you have cheat funds, right? Where you have people working together and saying that, okay, I will have a group and I will have a Vichy or cheat fund kind of a structure. Or another extreme, you have bank, right? Which is a completely trustworthy legal formal structure. Now this is somewhere in between. People started thinking, why can't you have just a platform where I connect borrower to lender? That was a very critical thing. Just connecting borrower to the lender, and making sure that they are able to figure out then whether to loan that person or not based on the available information.
Got it.
This platform which came, they had one job to do, which was bringing enough information and transparency when the data is shared by the borrower, and making sure that the operational issues like collecting money or disbursing money, sending reminders, automating those collection process, those are the things that they can do. And they can also do credit appraisal, because average investor is not aware about how to do credit appraisal. So the credit appraisal part also can be done by experts who are aware about how to do that. That was the idea behind, even before the guidelines came, that is how it was operating. But before the guidelines came, there were few companies who also were having that kind of a guarantee, saying that, look, I will, if it is a category, I will guarantee that your principal at least will come back. If not interest, I will guarantee your principal. So on P2P lending side, there were certain platforms who were guaranteeing this, that, okay, in the A category, risk category of the customer, I will guarantee at least principal. If the risk category is B, I will guarantee 80% of your principal, so on and so forth. So you had up to, let's say, 50% of your capital. Something like that was available in the market. But as Mr. Mukesh mentioned, you require legal structure in order to bring that trust, so that people can believe whatever is mentioned by that intermediary. And that is exactly where RBI had to come in because RBI had seen what happened in China earlier, what happened in Australia or other countries, where you have seen the bubble happening and then suddenly bursting. India cannot afford that, because you want that trust available in the ecosystem. Otherwise, in future, even that cascading effect may impact bank. So you don't want that effect to come into picture. And because of that, RBI was very clear that you want to regulate this platform and a market business as it is. You don't want it to become a bank or become an NBFC, a normal NBFC. So RBI came up with this guideline where they categorize this platform as NBFC P2P, a separate category, where they were very clear that it is a platform business, it is a marketplace business, and they should not get involved into other stuff.
Got it.
I'll
Thank you
just
so much
add,
for.
Shreyas, I'll just add one point here. Uh, and I want to reiterate. The guideline came in December 2017. August 2016, 2024 has only two changes. The rest of the guidelines were supposed to be implemented, and those companies which did not implement those guidelines were violating the December 2017 guideline.
Understood.
And today, that is what they are using in the market to confuse customers, saying the new guidelines are telling us to change the way we are doing it. No. The old guideline also meant we were supposed to be a marketplace. We were not supposed to become a quasi bank or a quasi deposit taking NBFC.
Understood. No, I'm glad you brought that up, and thank you so much, Vikram, for touching on to the previous guidelines. If you could, Mr. Mukesh, kind of take us slightly more in depth on understanding what was exactly the first set of guidelines that came in 2017, and what were the roles and responsibilities assigned to a P2P NBFC.
Sure. Let's break this 2017 guidelines into two parts. One, what the P2P lending companies could do and what it could not do. It's a very simple key 5-6 statements I'll make.
Right.
P2P lending platforms could only act like a marketplace. Number two, P2P lending companies could bring borrowers on the platform, do credit appraisal screening, and do the collection of the repayments back. They were required to have an escrow account, two escrow accounts from day one where the investor money will come, one where the borrower repayment will come. Number four, it could not, now I'm going to could not, it could not have given any guarantees directly or indirectly. It could not have participated in the NPAs, right? And it could not have cross-sold any product except insurance, which is linked for the purpose of borrower's default or against what we call credit insurance in the larger parlance in the banking industry for death of a borrower. And there was a final limit which was put initially in 2017 December. RBI said a particular lender could only bring 10 lakh rupees onto all the platforms and can give maximum 50,000 rupee to a borrower. Again, 1 lakhs and 50,000 to a borrower. That changed, and that was the only change which RBI made, which is customer facing, made it in December 2019 to 30 lakh rupees across all the platforms and 50,000 rupee per borrower. Right? And then August 16, 2024, it reiterated most of the guidelines, but it made three key changes. One, it said every month when the borrower repayment comes, you have to necessarily send it to the lender. Earlier, it was silent in the guideline, and silence, and it's not silence. I'll bring some points out. We used to take that money and get it reinvested. let's take Vikram as a lender on the platform. Vikram gave 25 lakh rupees to invest across various loans. And every month, let's assume we are collecting 1 lakh rupee for Vikram. Prior to August 2024, platforms would use that 1 lakh rupee and reinvest the money into new borrowers if Vikram wanted to. If Vikram wanted to, that's very important point to know. Now RBI has killed that process and said, no, you have to send it back. Number two, RBI has said the interest completely has to be shown to Vikram as a lender. So let's assume again, Shreyas, you are the borrower. If the platform has got you at 28%, Vikram should know you are paying 28% interest. And the platform has to declare the full fees what Vikram will pay. So that's 12%, 10%, 5%. That platform has to declare to Vikram upfront. And the third, more operational thing which RBI has done, and that's come out from the I think making the industry very difficult, is RBI has stopped auto invest, where now Vikram has to choose 25 lakh investment one by one himself. That's called manual investing. That has a root. There were two kind of platform practices. One, where platform asked Vikram, hey Vikram, what do you want to do with your money? You want to invest 500 rupee per loan, or 1000 rupee a loan, or 5000 rupee a loan? Vikram gave that instruction to the platform. Two, platform showed him saying, this kind of a profile of borrower, do you want to invest in this, or you want to invest in this kind of profile? So in a way, the lender himself chose the profile and the system ran for him, because for him, in P2P lending, the key thing is about diversification. And for Vikram to do that in his busy schedule every day is very difficult. But some platforms were not taking that instruction. They were taking only one instruction from Vikram. How many months do you want to give the money to us?
Right.
3 months, 6 months, 9 months. So they were taking the NPS on their platform, and they were taking the asset liability mismatches. Now RBI, in its own wisdom today, said, I'll just kill the auto invest process, such that Vikram has to now log in and choose every ball. So that's the change which has happened.
Perfect. I think that brings a lot more clarity to the guidelines. Having said that, right, I'm glad you touched upon the some of the practices that were happening, right? Because I'd also love to address that. What were the kind of practices that were happening in the gray area that led to the reiteration of the guidelines with some of the changes? Maybe Vikram, you could pick this up and start off with it.
Sure. So what happens typically is that, and look, it is always there in the ecosystem, right? That founder tries to identify that, okay, can I make use of certain gray area if there are, and then make the business big. And that is for any founder, fintech or non-fintech, people try to do that.
Right.
But fintech being the regulated business in a way, or under the purview of RBI, it should be very clear by now that what we have seen earlier also with the PPI instrument related stuff, what happened.
Right.
And given that context, it should have been very clear that where RBI is moving, what direction they are taking. So I think what happened is that in certain cases, not only the gray area, but the interpretation which they took, the interpretation of the law that they took was on the liberal side. Okay, so that is the issue which happened. Right? And I will tell you what people started doing in a way is that, so they created CUG, what we call as a CUG, closed user group. So
Right.
let's assume that you are a big company and you have merchant also, and you have some captive users also. So you can start creating that closed user group where you will pass on merchants data to one of the P2P lending NBFC, where you are bringing both supply and demand, right? So
Okay.
that way, what they started doing is, in a way, platform which is closed-ended platform, and they themselves were then trying to get the best possible rate matched, and then they used to take their own cut. So platform who used to bring this sort of demand and supply used to take their own cut, and then even P2P lending companies used to take their cut, right? And then they used to say, okay, you will get up to 12% return, where it is written that return might go low if the receivable or the amount collected is lower than that. But it was always in fine print. So what happened effectively is that risk became investors, reward becomes everyone's. So it means that as long as, let's say, I'm taking risk and my investment is going into risk category where they are charging 24%, I will still receive 12%. And they are maintaining whatever margin of safety that they were saying, they were maintaining it to manage the liquidity part.
Right.
And to manage that risk part, right? Whatever risk may arise. So that is what they were trying to achieve. But it means that if for whatever reason the return goes below 12%, I will suffer. But if the return is above 12%, so up to whatever 24 minus 12 is the benefit of both platforms who are involved here, right? Which is not what RBI wanted. RBI always wanted to make sure that if I'm taking the risk as an investor, I should get the proper return as well. That was very clear in RBI's mind. That's the reason RBI came up with this new guidelines where they are very clear that you should not promote this as an investment product. It is a borrowing that somebody is doing and you are lending it. So while people started saying it is the quasi FD or it is the investment product that you are getting, it should not be sold as such. That is number one. Second thing which RBI was very clear is that you should be or investor should be getting the full amount, and then whatever is the platform fee should be told to investor clearly in a fixed term, so that you cannot say that okay, if it will go up I will performance linked fee I can't charge. So it has to be a fixed fee. Whatever happens, you are charging your fee, and investor knows it beforehand. So investor knows that whether should I invest in this platform or that platform.
Right.
It should not happen that because NPA for me became less, I am paying more fee just because of that luck. And in some other cases, I will pay lower fee or whatever just because NPA is there. That should not happen. It has to be pre-told to everyone, informed to everyone, and it should be based on that. That is another thing. The last part, which used to happen earlier, right? And people started creating this sort of a quasi fund where people said, okay, I will collect the fund, and then I will make sure that whenever you want, I will manage that liquidity and I will give it to you. It can become in a way open-ended, where you can come and I can sell. So let's say you want to sell, I will make it available to someone who is trying to buy, and I will sell whatever you want to sell to that person, so that it becomes a new allocation to that new investor, right? So it is the existing running loan, and because you want to get out, I will sell your loan to someone. Again, RBI says you can't do all these things. It should be between a contract between borrower and lender. It is for that tenor. Let it get over. And unless until you have some like prepayment, some reason, whatever it might come, for whatever reason, then only it has to be repaid earlier. You can't do it otherwise. As simple as that.
Got
So
it.
this is what happened.
Got it.
I'll add few colors here.
Mhm.
The seed of, first step back, India always had NBFC structure, and there were different kind of NBFCs. NBFC deposit taking, NBFC housing finance, NBFC MFI, NBFC non-deposit taking, which is diversified, right? And RBI, when came out, put us under the same umbrella of NBFC, but a new category called P2P lending. I'm talking about December 2017, when the first time regulation. Now, if anybody had looked at that framework, would have realized that we are not a deposit taking company. We're not. We are a P2P platform, and it gave very clear guidelines in para 6.1, and that whole para 6 tells you what you can do, what you cannot. It was very clear the platform cannot take NPA. So, innovation of founders, where they said, okay, I will take my fees which will go up and down. And they started, another thing which they started doing is, just during COVID, is started selling 3 months, 6-month term deposit kind of product. While the word up to was there, they knew they have enough cushion and margin of safety to take away all the risk. 8% on a loan is very simple, even bank gives it to you, right? So the seed of all the problems started in the P2P lending companies were when they started assigning a term, 3 months to Shreyas, 6 months to Vikram, 9 months to Mukesh. That became a quasi deposit taking company. With 2 crores of capital, they started operating a business which requires minimum 300 crores of capital in an NBFC side, which is a deposit taking NBFC. That's the regulatory leverage they took. Number 2, Vikram, I'll just bring some color on the secondary market which you touched upon. Now, let's assume, Shreyas, you wanted only to give money 50 lakh rupee for 3 months because it is a better yield than liquid fund or a deposit. You are happy it will come back to you. But we all know in the loan business, Shreyas, there will be at any particular time some bad loans who have not paid. It could be for 1 day, it could be for 90 days, it could be for 180 days. And let's assume you gave this money on 1st January. Your expectation is, I'll take 8%. I'm happy with that. I need that money for giving it to a builder, or I want to use it for wedding, whatever. Now, on 1st April, you had, let's assume, 100 loans which were bad. Now, Vikram is either a new lender and Mukesh is an existing lender whose money is not invested. They will take my money and Vikram's money and pay it to you. You will feel fantastic. You got your 50 lakh and you'll get 8,000. But Vikram and Mukesh have no clue that they have been stuffed with a bad loan. Right? So we are completely, it's like a musical chair. If at some point of time, whoever is standing last may get stuffed with a lot of bad loans. So I'll go back. The seed of the problem started with version 2 of P2P. They called it version 2 of P2P in the industry, where they started giving funds for 3 months, 6 months from the investor, but investing in 9, 12 months. And today, a lot of P2P players they don't have matched lenders and borrowers. So in platform like Monexo, I can, in a click of a button on your app, Shreyas, you can see who are your borrowers, and Vikram can see his borrowers. And there may be some overlap, there may be no overlap. Your return will be very different, Vikram return will be very different. But in a lot of other platforms, Shreyas was not given any loan portfolio. The portfolio was managed like a bank. The separate lenders were managed separately. So all of you got, if you gave money for 3 months, you all got the same return. If we all gave money for 6 months, we got the same return. That's not which was P2P lending from almost March 2020 when it started. From there onwards till today, it was not what was P2P lending.
And couple of things that I will add, right, to make sure that there is a full color to this. So if you consider from the perspective of innovation, not all innovations were really bad if you really think about it. Some of them were very logical as well. So I will give you a very simple example of what Mr. Mukesh mentioned earlier. Right? So when you look at from the perspective of matching, auto matching based on my own preference. So let's say as an investor, I have given my consent that I want to deploy similar to what NPS allows you to do, by the way. So you can say I want to put my 30% in A category or A and B category, 40% in C and D category, and rest of the amount in EF category or very high risk category for that. So if I mention as an investor, I am mentioning that, and then automatically if the platform is matching it, and what happens typically, people always say, look, in P2P lending, the NPAs are 5% or 6%, whatever that number is. But as an investor, you cannot look at that number because that is the average number on a portfolio level, which means that unless and until you are well diversified, you will not be subject to that industry average. You will be subject to your luck Because if the loans are such that by somehow you have invested into some more risky loans, you may get like 50% NPA ratio as well. So in order to make sure that you are getting well diversified portfolio, it is easier for me to then specify my risk appetite, and based on that it is even easier for platform to then match and auto diversify my portfolio, which is a good practice. Because end of the day, I would like my investment to have NPS similar to the industry. Then only it will make sense for me to invest into this asset class in the first place. Otherwise, I would not like to invest into asset class where I need to think way too much, and after that I may end up with 50% NPA also. So first of all, my effort time is required to identify the right borrower, and then also I may not get the benefit of the diversification which I want. So that's the reason certain innovations are good. Similar to that, certain innovations where, again, right? So when you are talking about uh, you offering it yourself, let's say in the secondary market, which is properly disclosed and transparency is there, that okay, this is the track record of this loan so far, and there is a transparent market, then it makes sense because you are providing more liquidity in the market, and the same loan with the same remaining tenor is what you are able to sell. And that is any which ways today, if you look at the remaining maturity or let's say the tenor, whatever it might be, somebody may want to take that exposure. It is real exposure that you want to take as an investor, because I want to only invest for 1 year. So somebody is selling only for 1 year, I can get into that. And its maximum is 3 years. So you can not go anywhere beyond that. Right? So those are the opportunities where the true innovation can happen. But when the innovations which were happening were not as per RBI's requirement or thought process, RBI said, let me be very clear. And RBI, interestingly, this time has even drawn diagrams to remove any ambiguity. Earlier, RBI written certain text. So people said that, okay, let me figure out loophole here and here. But RBI says, no, I have drawn you a diagram. Follow this diagram like this, so that there is no confusion whatsoever. Even RBI is saying specifically in clause 12.2 that, okay, look, I am now specifying. The same thing is repeated and then it is specified that you cannot showcase that as an investment which is linked to tenor, liquidity and all those things. You can't do that. So they are specifying the same guidelines that they had put, right? They are specifying again that, look, this is what I have seen. I don't want you to do that. It is very clear that RBI has addressed those specific things, which RBI thought is not correct.
Fair enough. Thank you so much for bringing that out. A couple of things that kind of just stuck with me, right? One was a practice wherein you said that they were offering pseudo fixed returns, right? The product that both of you said, quasi FT. For example, I remember investing, and I've been an active investor in P2P platforms since past 3-4 years. So there were multiple products, and as you said, during COVID times, there were a new set of products that came out. For example, itana karo, whatever, right? So there was a product that offered you 12% fixed for 3 months lock-in. And in that case, essentially the assumption is key, and as per the RBI guidelines, it is said key borrower and investor should first of all know who the other person is. Second thing is key, I should know how much I am charging the borrower as an interest rate and what is the platform fee. So, for example, when you look at it, or it would be helpful if one of you could draw a parallel to me over there. So, if you could kind of take me through that user journey of discovering how that mechanism works, wherein if I'm investing my 1 lakh for 12% for 3 months, right? 12% per annum for 3 months. Then, वहाँ पे जैसे I had Vikram at one point of time said कि the borrower could be paying anywhere between 16 to 20 or 24% interest rate, and the platform fee could be dynamic so as to absorb everything above 12%, and that would also absorb the risks. So when you look at it from an investor's perspective, at what point of time does this stop being good? कि यार 3 महीने में अगर मुझे 12% per annum के हिसाब से return मिल रहा है, so and when does the risk factor, at what point of time does the risk kick in, and when should an investor be worried about this?
So first, जो product Prayas you bought was already out of guideline. Now there are two parts. Is the product good for the customer? Is the product within the guideline?
Right.
Now the product can be good for the customer but not within the guideline. That product should not exist. The reason being, you are taking a trust of a regulator, not abiding by the regulation and selling another product. So how is that good for anybody? अगर यही मेडिसिन में हो जाता, यही एयरप्लेन पे हो जाता, तो you would have said कि ये क्या गलत काम कर रहा है. Right? Now, second part, the product which you were sold, and I have said this vocally earlier, is called collective investment schemes. It's a CIS, and that is governed by SEBI. It is not governed by RBI.
Right.
What you were all sold was a collective investment scheme. Now, what can be the future problem and why RBI had to act? And I'm happy they acted, and I wish they'd acted much ahead of time. You are now getting used to a assured return. A credit bubble is always getting created in any economy. We have had reading newspapers, RBI point, it's saying MFI is going out of hand, there's too much of risk out there, consumer loans are growing in India, India is becoming too much borrowing country right now. Now, suddenly let's assume that COVID plus the economic downturn happens, or even economic downturn happens, what happened in US in 2008. It is not, then what all of us as individual lenders to this platform will be left with nothing at that point of time. Right? That's the false promise we were sold, and we have to be walking out of that. If you are told, let's assume we go to stock market today, we know the price can go from 100 to 600 rupees, or it can become from 100 to 0. We openly take that risk.
True.
We are fine with whatever money we've allocated to that asset class. Similarly, here what you've been told is, don't worry, we'll give you in the next 3 months 8% return per annum or 12% per annum. But they never told you that can become 0.
Agree.
Today, that's what is happening in few platforms. RBI is told, hey, stop returning money to all the lenders. As you collect, and that's why it said, if you have not matched the borrowers earlier, finish the mapping and matching now. So Shreya should know that he's given his 1 lakh rupee to these 100 or 200 borrowers. Vikram has given this 100 rupee, 1 lakh rupee to these borrowers, and they're going to pay like this. Now, the platforms don't have any more money left suddenly because no new inflow is coming. And everybody who had the hope that 3 महीने के बाद पैसा मिल जाएगा, they suddenly got locked jam.
Right.
Again, going back, the seed was sown the day any platform sold for 3, 6, 9 months. It is not a 3. It's a platform business. It's not a fixed deposit business.
Makes sense.
Vikram, your thoughts?
Yeah, so definitely what additionally you need to understand is that, look, there are two things that any investor will need to understand. So even I was investor in P2P like as an individual, not as a fund or something like that. As individual, I invested as a let's say investment in the one of the P2P lending NBFCs. So it was the erstwhile structure where I knew exactly where the money is there. While it was, let's say, 500 rupee, maximum 4,000 rupee per customer, that was the structure. But I knew. And even despite COVID, I'm interested, like very interesting to note, right? Despite COVID, when like my average return could have been 23% or so, despite COVID and NPA, I got 13% IRR in a way, 13%, right? So which is good, which is the risk that I am taking. I know that it might become 0, my principal may become 0, but I am getting, despite COVID, this return. But in that 12% thing that you saw, let's say margin of safety is 6% because they are taking good cream out of it, right? They take that cream. So let's assume even if you look at the investment products and if they are saying I'm keeping margin of safety of 6%, 9%, and if the NPA is much more than that, which was the case during COVID, so if you compare that, then you are definitely bound to get return lower than 12%, which you are promised, because it is not promised, by the way, it is a star and written in a fine print that up to 12% return. While many people were told it is 12% by the distributors, really to make sure that it is saving their own legal thing, right? They are writing very clearly it is up to 12%. So in that case, if COVID-like scenario happens or whatever downturn happens, you are ending up with maybe negative principal, not even interest. I'm saying negative principal scenario. But they have taken whatever they had to take earlier when the market was working well. But now you are stuck with the negative return. Understand that. You are stuck with the negative return. So even earlier, if you knew and you are getting even upper side or higher side return, and then you are getting lower side, then you can average it out and you are happy with that. But here it is always like that. You are not getting upper side, but you are always getting lower side. So upside you never get, but downside it is always yours. That is the issue, which should never happen to any investor, right? Because margin of safety, whatever you say, but ultimately, legally, you are transferring risk to me, which means that if the sudden market crash happens, etc., I will not get the return which is mentioned while I'm losing on the upside.
Makes sense. So
And
just to
shares one more, just the word margin of safety, right? P2P guideline was very clear from December 2017. P2P platform cannot give credit enhancement, credit guarantee. What is credit enhancement or credit guarantee? It is taking risk and taking in their own P&L. Right? I'm taking the risk in my fees. That's credit enhancement. You can call it performance risk. It's like you've been sold a mutual fund where you're saying up to 12% return is yours. Uske baad jitna bhi return आएगा वो मेरा है. That's not. और losses होगा तो आपका नहीं है, वो मेरा है. ऐसे थोड़ी ना होता है. Right? In mutual fund also you take the risk and you make the returns. The platform, the mutual fund asset management company takes, earlier used to take up to 5% entry load. Now because the market has become so huge, they're less than 1% entry load. Right?
Okay. So just to kind of clear one thing out that I'm still a bit easy on is when you talk about this kind of a product, right? Whatever percent fixed up to whatever percent fixed for a certain amount of period of time. How do these elements stack on top of each other and how does risk look in it? So from what I understood from what Vikram said, that up to 12%, whatever interest comes in, even if the borrower is paying 20%, 16%, or anything more than 12%, you get up to 12% returns. Again, it's up to, it's not 12. It is up to 12. So 12 से कम हो सकता है, 12 से ज़्यादा नहीं, right? In case enough borrowers, अगर मैंने 1 lakh invest किया, obviously that's been distributed to, I'm assuming 10 borrowers at least. So in case enough borrowers default to give me the impact, to bring the impact to amount to negative principal, does that mean that I have unlimited downside risk wherein my principal could go to zero as well?
Would have gone before August 16, 2024. It didn't happen. But think, again, very common. That's what banks do, right? Banks know that, hey, Shreyas has put 1 lakh rupee in FD for next 12 months. That money is with me for unless there's a break. Shreyas needs the money, but they have enough models which can tell you they have thousands of Shreyas and they have all given money for 12, 24, so they know it. And on the other side, they have lots of different kind of products: personal loan, housing loan, credit card, car loan, gold loan. So they have diversified the borrowers.
Right.
So they know, okay, even if Shreyas wants to come back, their new depositors, I'll pay him back. Right? Or repayments is coming, I'm going to pay him back from there. And then there's a CRR, SLR, which they need to maintain with RBI to make sure they have enough liquidity. But P2P lendings are not required to have CRR, SLR, no deposit taking kind of. So suddenly if Shreyas wants, and they had this product, liquid product, right? Where you could take your money out anytime.
Right.
So these innovations were not innovation. They were really out of line of the regulation. And margin of safety was a product which was trying to tell you, hey, don't worry, I will cover all the risk. I'll give you 12%.
But again, in that covering all the risks, I was still legally the losses risk was still mine. The legal risk was then transferred, right? While they were promising कि यार हम कर लेंगे, manage कर लेंगे इधर उधर से, like
Yeah, they
if
were not promising, by the way. The distributors might be promoting. They were very clear. So they were in the product, they were writing up to 12%, but distributors might promise that no, you will get 12%, you will get 9%, for example.
but
They,
downsides का क्या था? I'm
that's
still
what
a
I'm
bit
saying.
crazy on that.
Promoted like that, but they were very clear in that legal language that it is up to, and you might get lower. That was very, it was written in
But
fine print. So
the
it was,
risk was also, there was a genuine risk of getting negative principal as well in that.
yes, yes.
एंड यहाँ पे उल्टा वर्क करता इन एनी इंडस्ट्री. मतलब हम बचपन में जो पार्टीज में म्यूजिकल चेयर खेलते हैं, जो लास्ट में खड़ा रहता है वो विनर होता है. यहाँ पे जो लास्ट में खड़ा रहेगा वो लूजर रहेगा,
Got it.
क्योंकि तब तक उतना बैड वाटर वुड हैव इंक्रीज्ड वेयर इट वुड नॉट हैव मेड एनी sense for the platform to continue. Right? It could not have absorbed their expenses. They could not have absorbed the losses. Then they'll just transfer it to. And there was a tweet by one of the founders of one of these clubs nowadays in 2 years back, where he said, withdraw all the money because we are seeing huge losses and we are selling a portfolio to ARC. So there was a tweet available on, and then it's got removed. But he said we cannot afford to give 12% anymore.
Makes sense.
And the reality, I will tell you what happens, right? Unfortunately or fortunately, look, market forces may eventually force you to ensure that you are making profit, right? Because whatever the scenario might be, people knew that VC fund also wanted profit. So this innovative product, in the name of innovation, ensured that they are profitable suddenly. But it was not the profitability which was sustainable in future as well. If you are working with such product, unless and until you do some kind of engineering, financial engineering, and that was not something RBI can tolerate beyond a point. So I think what RBI did is, in a way, very good for the investor community in general. As I mentioned, certain innovation could have been allowed. Maybe it will be allowed later, who knows, as the ecosystem matures. But right now, RBI said enough nonsense. We want to put certain guidelines and certain boundaries to what you can do. We were very clear earlier, but now we are making it like very, very prescriptive. No room for any misinterpretation at all. So you are very clear on what they want.
Understood. Fair enough. So I think this brings me to the next question. Is it what exactly are the new guidelines? What has changed, and what are the new prescriptions that needs to be followed if one needs to be in the business?
So I'll take a stab from a customer point of view.
Okay.
Let's assume Shreyas and Vikram, you are the two new customer wanting to join today on the platform, any platform. And each of you want to invest 50 lakh rupees.
Right.
So up to 50 lakh, you can invest across all P2P platform that was there. It is still there. You have to get a CA certificate. You have to do online onboarding and do your KYC, which was there earlier also, even now. Now the platform has to show you all the lenders and the interest rate there which they are charging and what their fees is, and you will have to select those loans manually. Let's assume for 50 lakh rupees you require to diversify across 5,000 borrowers. You have to do this manually currently. Earlier, what Vikram talked about, there was certain innovation which is good, where you could take the instruction from the lender and do it through machine. And there were certain platforms who were just doing it themselves. So now, because that has been changed, you have to manually select. Now let's assume the platform does not have that many loans where you can participate. With 1,000 rupees, also 5,000 borrowers have to be brought in 1 day's time to you, right? If you don't do, the platform cannot invest that money. It has to send it back to you. So you invested only 10 lakh in 1 day. Vikram also invested 8 lakh rupee. I have to send 42 lakh rupee back to the, I means the platform, and you will get 40 lakh rupee back from the platform. Now you will suddenly start as a consumer, what happened? I gave you 50, why you send me back? We'll say this is the new RBI guideline. If you want to invest, please send it again. This is for the investment process. So you have to choose manually. Platform cannot keep the money more than T plus 1 day. So it becomes challenging. So cost of acquisition of a customer or a lender will go up, and lender will find it very difficult to give a large sum of money at one go. Now you've invested your 10 lakh rupee. Vikram has invested 8 lakh rupees. Each of your portfolio is mapped to you on day one. Next month, the repayment starts.
Right.
Now you have 1,000 borrowers, Vikram has 800 borrowers. The platform starts collecting. Not every borrower will pay on the same day.
True.
Some will pay on first, some will pay on second, some will pay on fifth, some will pay on 10th, some may even pay until 30th. Now, each of these payment collected by the platform has to be sent back to Shreyas and Vikram again on T plus 1 day. So let's assume I collected on let's assume it's all happening on January 1st. I will collect 200 rupees for you and 100 rupees for Vikram. I have to send this back as a platform to you immediately in T plus 1 day.
Understood.
So now you will get every EMI back to your account. The platform cannot reinvest, or you cannot give the instruction to the platform to reinvest.
Got it.
So your capital, which you thought will come in one go, you've saved this money and you want this back in one go, right? At some point of time, whenever you need it. Now it'll come in trickles and drabs for you. And for the platform, it will increase the cost of operations. Because every time, even if I have to send 100 rupees, I may have to spend 3 rupees on IMPS.
True.
Right? Just imagine I have to send 10 rupees back to Vikram on 30th because that's what I've collected. That means I will have to spend 3 rupees. That's 30% of your sudden cost increase, right?
Right.
So it creates a very bad experience. Consumer experience is now in the new guideline completely broken by 3 aspects. One, this T plus 1. 2, you have to choose manually. Now, just imagine I have some doctors on my platform. Some of them called me even yesterday and said, I don't even have time to breathe. I'm I do 3 operations or 4 operations a day. Then I have patients. When do you expect me to do it? I said, this product is not for you anymore. I can't help you also.
Makes sense.
Right? So a lot of people who are professional, they will not be able to use this product. Maybe people who have 10,000, 15,000 rupee want to try this product for some time because it will give them 26, 27% return before the fees, before the NPS. They will try for experimentation purpose.
So interestingly, there are still, because the way guidelines are written, even new guidelines, right, and it is like very clear, but still, in the case of board approved policy of matching borrower and lender, that's what they have mentioned. Right? So people are still now contemplating that can you still allow first time auto investment matching, because you can have board approved policy which can say that okay, if the investor is saying something like this, I can have the recorded consent, because they have now mentioned about recorded consent also from borrower. Similar to that, you can have lenders consent that okay, I am taking this consent. So people are still contemplating that can we have this matching policy, and first time matching we can still allow automatically, but reinvestment is not possible for sure. It is very clear. So the first part is still something people are wondering, can we do it in that new form or fashion? It is still people are arguing. But in my opinion, it might be possible that board policy is written, but still it is a cautious approach that you need to take.
Makes sense. But I definitely, feel that the customer journey has been impacted. While the customer journey has been impacted, I think the initial move seems to lean strongly towards, kind of securing consumer safety and securing the principles. Having said that, what also essentially I can see here, and probably I think you guys will be able to give a better view on, is from an impact perspective, this curbs all the essential gray area practices, so as to say. And this brings us to again day zero of P2P lending back in 2017, wherein most of these guidelines were in place. And the new consumer experience might have to be defined and might not evolve the way so it has. So for example, if you look at it from 2017 to 2024, the way the consumer experience or the front end had evolved is now all scrubbed back to zero, and a new CX development will have to come into play to ensure smooth flows. And as Vikram said, like if the first time auto invest comes into play, I think that will essentially give you a slightly better consumer experience from that perspective. Having said that, would love to hear your views on how do you think this will impact the P2P industry moving forward. Where do you see the existing players which are operational currently with huge customer bases kind of moving, and overall how the industry will, which direction the industry will move?
So if I were to start, I think interestingly, what will happen? Look, why we need to understand how the growth happened. Right? The majority of the growth happened via B2B2C. It was never direct B2C growth. It was
True.
always B2B2C growth, where they identified affiliate or partners who gave them closed user group, and then that growth suddenly happened, right? So because of that, you had even like growth coming in few thousands of crore in one day, because suddenly you have a partnership, and from maybe 10,000 crore you got into 50,000 crore club just because you had
Right.
some partnership, right? So
Right.
that will be now impossible. It is not allowed, explicitly written, it is not allowed, which means that you cannot do that sort of partnership.
The anchor model is out of the window.
Model is out, CUG model is out, which means that the organic growth that you need to bring will make it very, very difficult for this sort of platforms to maybe run. Earlier they were running, now, or let's say flying. Now they need to walk for some time and make sure that they again build that sort of distribution network or whatever, right? Because you need to make end customer aware rather than just bringing via some sort of partnership. It becomes very difficult. So the issue becomes that, look, if you don't have anything for the affiliate on the plate, let's say there is no revenue share which you can present, so nobody is interested in that, right? You need to have some
Right.
sort of win-win situation for everyone to work. So in this scenario now, the growth will become very difficult for this P2P NBFCs.
Got it.
Very frankly, as an investor, when you think, right, I'm talking about from a VC perspective. So
Right.
VCs will not invest into this sector very quickly. So they will wait and watch what kind of growth which companies are able to bring. And eventually
Right.
you will see consolidation happening, definitely, where some of the bigger companies might merge and try to stay operating. Because unfortunately, what happens is that, as Mukesh mentioned, you cannot afford this sort of increase in operating cost while still delivering that sort of experience and return to the investor. If the investor is not able to see lucrative return, then why will that person take this much risk? Today you have
True.
even corporate bond as a product, etc., which is again governed product, and they are also offering 11% whatever. So they will say, okay, I'm happy with that. Let me go to
Right.
that area, and rather than wasting my time, effort, energy here, and I don't know what may happen. So that is the reason I think this product may suffer in a short time, but I think there will be winners who will emerge. There will be consolidation which will happen. Players who are really doing that proper business and making sure that there is a proper market which they have created in the long term will survive.
Makes sense. Makes sense. Also, is it safe to say that B2B2C model is completely out of the window for P2P lenders for the near short term or for the foreseeable future?
CUG
And
led, yes. CUG led, yes. Mukesh can add more picture to that. Yeah.
sure.
So closed user group is closed for good. And again, uh, there was a lot of violation, and P2P lending company said, hey, I'm not doing it, that guy is doing it.
Right.
It was your license. Example, there was a platform which gave withdrawal of daily interest. I, as a borrower, did not pay daily interest. So how did the platform give it as a daily interest
Exactly.
cash back to you, right? So these are all psychological games they play to bring consumers in, but that was all outside the line. But
Right.
let's also remember, I tend to agree with Vikram myself, and I've grown very, very slowly compared to any of the platforms. Purely, I wanted to be on the right side of the guidelines.
Right.
I always did with taking instruction. Yes, I had to follow some part of the industry, but I never did the 3, 6, 9, 12-month products.
Got it.
I took instructions from the customer, and today RBI does not differentiate whether I took instruction and run auto invest, or I took instruction from Vikram that Vikram, hey, he wants to sell his 10 lakh rupee loan, thousands of them, and I only allowed him to sell the good loans. And Shreya saw them and bought them. Still, my secondary market is closed. So Vikram cannot get an exit. And there, the other platforms were just bundling everything and throwing to in somebody's portfolio, right?
Right.
So RBI just closed all the doors right now. It will hopefully open. I think we as an industry have to earn the trust again. We have to demonstrate that we are a fit and proper founders to get that leeway back. And finally, see, the borrowers have choices. Now imagine you go to a website where borrowers are listed, but now the lenders are busy. Do you think the borrowers will stay in the platform for more than 24 hours? No. So even if Shreyas invests money and Vikram does not, then means Mukesh's loan cannot get fulfilled. And Mukesh will say, hell with this, cancel my loan, I'll move on, right?
Right.
So it's a very vicious cycle which will really ramp up our cost. So as of now, I think most of the platforms have paused. Few are trying to do it. Again, consumers are not coming in hordes like the earlier time. I just wish if I had time travel, go back to 2017 and restart with talking to RBI, talk to the industry players and say, we are in it for a long term. Don't think of this product as 5-year product or a 6-year product. Mutual fund today is if I don't go back to 1964 UTI fiasco, but even in 1990 nobody wanted to buy a mutual fund. 2000 nobody wanted to buy a mutual fund. 2005 nobody wanted to buy a mutual fund. But suddenly come demonetization.
Right.
Suddenly this SIP book grew from 3,000 crore to 8,000 crore to 12,000 crore, and today people are talking about 20,000-30,000 crore of SIP coming in. It takes time. We are building a new industry, and I wish we had not gone from being an information aggregator to a credit aggregator. Even China failed because the Chinese P2P companies became a credit aggregator and the regulator did not like it. And we also became a credit aggregator in India and the regulator did not like it.
Makes sense.
I
So I
still,
think
no, I still remember, I think, the period before the original guidelines, right? Where few platforms had tried. It used to take around a month to fulfill a loan. I'm telling you reality, right? It was, in fact, there was a period given. So there were two bars appearing. One bar was for the period, number of days remaining, like what you have in Kickstarter, right? Like you have number of backers and like what is the time period remaining. Exactly same thing. So you had that sort of the bar. I think those days are going to come back.
so that's from a UI perspective, UI UX perspective, that entire game is again going to go back and change.
I'm saying waiting period. Right now,
Waiting
what used to
period as well.
happen, the moment somebody wanted loan, it used to get filled immediately because you had enough demand available. So
Exactly.
demand is there and enough supply is there. So you had enough supply and demand which can be matched easily. So in fact, sometimes you had more demand than supply. Or you had more supply. In that other words, if you look at more supply than demand, right? So you can always fulfill the demand which was there. And because of that, what used to happen, immediately the moment borrower used to come, he used to get fulfilled. Which is also bad.
Got it.
Sometimes you should have certain bad credits to wait. But anyways,
Makes sense. No, as you rightly said it, I also remember BNPL products being backed by B2B lending platforms in many cases, and that is almost an instant demand generation and fulfillment.
Correct.
So it is always crazy to think that how is such kind of liquidity being managed by platforms in the back end, right? There is always some float money lying somewhere which was essentially funding those instant this thing. No, having said that, I think this was really great. I think we got a lot of perspective on what's happening in the industry and where the industry is going. And to summarize the discussions that we had, I think starting from 2017 when the guidelines came out and pre 2017 when a few platforms were operating and trying to experiment with a few models, post which guidelines came and said that P2P lenders have to be a marketplace that will connect a borrower and a lender, create a layer of trust and transparency with visibility of what the borrower is supposed to, what the borrower is going to pay, what would the platform fees be, and essentially the duration of the loan, after which you can, you'll get all your principal back. From that, the industry evolved in around 2020, 2022, between that COVID period to a period wherein you got products wherein you could just invest for 3 months, get 12% per annum rate. You didn't know who you were lending to. You didn't know how many borrowers you were lending to as an investor. I'm talking from an investor's perspective, as well as instant fulfillment of loans from a borrower's perspective. There were good things were instant fulfillment of loans. जब चाहिए तब credit मिल जाता था. As I said earlier, also products like BNPL being there, funded by P2P lending platforms. So I think more credit products being out in the market because they were being backed by P2P lending platforms. We also saw at one point of time PPI products being used by P2P lending platforms to issue card-like or digital card-like products for instant credit line disbursement, which I think was again chopped down very quickly. From that product again, I think as Mr. Mukesh said correctly, that the thing that bought in or that kind of spiked the curiosity or hit that red line for the regulator was when essentially instant liquidity was offered to investors. In the sense, I kind of when I came to know about this entire process, I kind of tended to compare this with what was happening back in 2008 with in the US crisis or the subprime crisis, as we talked about, that passing the parcel or musical chairs happening, wherein the bad water has been syndicated or securitized and kind of transferred to the next bakra or whoever comes in, right? कि ये पूरा portfolio इसमें. So starting off with maybe 10% bad loans and 90% good. By the time the parcel reaches the other end of the line, you end up with around 90% bad and 10% good loans. As you said, the last person standing gets the.
Fortunately, you don't know that percentage because on top of that, you have so many security and statistics coming into
Exactly.
Nobody knows them. That's the issue.
So many securitization and syndication layers are there. It comes from CUGs and multiple things in between.
Hidden cascading impact and correlation, which is hidden. You don't know.
Right.
And
Exactly.
once that triggers, you are in a way screwed.
Right. So ultimately, because of all of that, the regulator had to come into play and introduce the new guidelines that we kind of walked through with Mr. Mukesh and Mr. Vikram. We kind of said that now P2P lenders have to go back to the basics, and the entire journey from a user perspective is now back to where it was in 2017, where the customer has to go, the investor has to go select the borrowers that he wants to invest in. The loan has a certain amount of time in which it needs to be fulfilled. Is there a regulation that says what's the limit which needs to be? Is there a time limit in which the loan needs to be fulfilled as of now?
We can
None.
keep the money of any individual lender maximum for 1 day.
So technically, that becomes a timeline.
Not necessarily.
You can just get commitment. You can just get the commitment, and then you can always ask them to deposit when the period is available for that settlement. You can always do that.
Understood. So, but still, the loan needs to be filled as quickly as possible for
The borrower does not want to wait.
Right.
The market. See, if you look at what is ULI also talking about, frictionless credit. And they want to give loans in 5 minutes to a lady in village. Now, if frictionless credit is possible, and we've built all that platform, frankly.
Right.
I also have account aggregator. I also have everything possible in frictionless credit. I also know which dairy farm to go and partner with and know what is the output of that guy and give him loan.
Right.
Land records are available, satellite data is available. I built all that platform. But today I will not be able to fulfill that loan to that lady in 5 minutes. I will tell her, please wait, madam. I have to go to Shreyas, I have to go to Vikram, I have to go to Mukesh and ask them to send money first and then I'll give it to you. Now that is not level playing field.
Of course.
Right? RBI has done many cuts to P2P lending companies. One was when they introduced the 2017 law guideline by putting a 10 lakh rupee limit. Second, it allowed this new word which they coined LSPs. They ran amok for 3 to 4 years.
Right.
And we inflicted pain as an industry on ourselves.
Mm-hmm.
And now this new havoc of a guideline which swings the pendulum all towards customer protection. And in a way, the way I'm describing it is, there was a few snakes in the house. RBI could have either killed those snakes or locked them in the room, but it came out and closed the whole house itself, saying this is a house infested with snakes.
Right.
Right.
Makes sense. So that entire consumer experience from a borrower's perspective has now been again, taken back to 2017. The loans will have to be filled in as the borrowers come in, give the commitment. If not, that should be returned in one day. That's a short summary of the new guidelines. We'll also be attaching the links to those guidelines for your reference and probably show some screenshots while the conversations is going on for the viewers advantage. So please keep an eye out for it. And with that, I think would love to conclude this episode for today. Thank you so much, Mukesh and Vikram. I think it has been a pleasure and quite an informative session for me as well as the audience. Thank you so much for your time.
Thanks for
Thank
having
you,
us.
sir. Thank you, Vikram.